Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the dismal science of economics and turns it into a full-blown circus of absurdity. I'm your ringmaster, your financial fortune teller, your caffeine-fueled Cassandra of capitalism, here to break down the latest economic madness with a side of satire and a sprinkle of existential dread. Buckle up, folks, because today we're diving headfirst into the Federal Reserve's latest tightrope act, starring San Francisco Fed President Mary Daly, a cameo from Jerome the Rate Whisperer Powell, and a supporting cast of tariffs, inflation, and a labor market that's starting to look like it needs a nap. Let's go. Alright, let's set the stage. It's August 30th, 2025, and Mary Daly, the San Francisco Fed's fearless leader, has just dropped a bombshell on social media because apparently, that's where monetary policy lives now. She says, and I quote, "It will soon be time to recalibrate policy to better match our economy." Translation, folks, the Fed is itching to cut interest rates, and they're ready to do it faster than you can say quantitative easing. But wait, there's more. Daly also says that inflation from tariffs, yes, those pesky trade war relics from the Trump era, will be, drumroll please, a one-off. A one-off. Oh, bless her heart, she's out here trying to convince us that price hikes are just a temporary blip, like a bad Tinder date or a TikTok trend. But here's the kicker, she admits, it will take time before we know that for certain. Oh, Mary, quite contrary, how does your economy grow? With uncertainty, tariffs, and a labor market slowdown, apparently. Now, before we dive into the juicy economic issues behind this, let's zoom out and look at the big picture. The Fed has been holding interest rates steady at a range of 4.25% to 4.5% all year, which, for those of you keeping score at home, is still pretty darn high compared to the near-zero rates we were spoiled with during the post-COVID recovery. But now, with inflation ticking up thanks to tariffs and the labor market starting to wheeze like an asthmatic marathon runner, the Fed is caught between a rock and a hard place, or, as they like to call it, their dual mandate of full employment and price stability. Spoiler alert, those two goals are currently having a lover's quarrel, and we're all stuck watching the drama unfold. So, what's really going on here? Let's break it down, Boss Economics World style, from the surface-level shenanigans to the deep, dark economic underbelly. Grab your popcorn, folks, because this is where the satire meets the substance, and the data meets the drama. First up, let's talk tariffs. Tariffs, the gift that keeps on giving, courtesy of former President Trump's trade wars, which are apparently still haunting us like a bad sequel nobody asked for. Daly says the inflation from these tariffs is just a one-off, but is it really? Let's look at the data, shall we? According to the U.S. Bureau of Labor Statistics, the Consumer Price Index, CPI, rose by 3.8% year-over-year in July 2025, with a significant chunk of that increase driven by higher import prices on goods like steel, aluminum, and electronics. Gee, I wonder why. The Peterson Institute for International Economics estimates that Trump-era tariffs have cost American consumers an extra $50 billion annually, and that's before you factor in the retaliatory tariffs from countries like China, which have jacked up the price of everything from soybeans to semiconductors. Now, Daly wants us to believe this is just a temporary blip, but here's the thing, tariffs don't exist in a vacuum. They ripple through the economy like a stone thrown into a pond, or, in this case, a boulder thrown into a kiddie pool. Higher import costs mean higher production costs, which mean higher prices for consumers, which mean, yep, you guessed it, more inflation. And let's not forget the latest twist. As of August 2025, the U.S. Trade Representative's Office is considering expanding tariffs on Chinese tech goods, citing national security concerns. So, Mary, tell me again how this is a one-off. Sounds more like a one after another to me. And here's the kicker, folks, inflation isn't just a number on a chart. It's the reason your grocery bill looks like a mortgage payment and your morning coffee costs more than a Netflix subscription. According to a 2025 report from the Economic Policy Institute, the bottom 40% of U.S. households, those least able to absorb price hikes, are spending 78% of their income on essentials, up from 72% just 2 years ago. So, while Daly and the Fed are out here playing 4D chess with monetary policy, regular folks are playing a very different game. How do I afford to eat this month? Next up, let's talk about the labor market, because oh boy, it's starting to look like it needs a vacation, or at least a strong cup of coffee. Daly says the Fed can't wait for perfect certainty without risking harm to the labor market, and she's not wrong. The latest data from the U.S. Department of Labor shows that hiring slowed to a crawl in July 2025, with only 114,000 jobs added, down from an average of 215,000 per month in the first half of the year. Meanwhile, the unemployment rate ticked up to 4.3%, the highest since late 2021. And don't even get me started on the quits rate, which has plummeted to its lowest level since 2020, signaling that workers are too scared to leave their jobs in search of better pay or conditions. Welcome to the Great Stagnation, folks. Now, why does this matter? Because the labor market is the beating heart of the economy, and right now, it's having palpitations. A slowing labor market means less consumer spending, which means less economic growth, which means, yep, you guessed it, a potential recession. And here's where the Fed's dual mandate comes in. They're supposed to keep employment high and prices stable, but with tariffs pushing inflation up and hiring slowing down, they're stuck in a classic catch-22. Do they cut rates to boost hiring and risk even more inflation? Or do they hold rates steady to fight inflation and risk a full-blown labor market meltdown? Decisions. And let's not forget the human cost of all this. According to a 2025 survey by the American Psychological Association, 62% of U.S. workers report feeling financially stressed due to stagnant wages and rising costs. Meanwhile, corporate profits are still soaring. S&P 500 companies reported a 12% increase in net income in Q2 2025, according to FactSet. So, while Wall Street is popping champagne, Main Street is popping antacids. Sounds like a fair trade, right? Finally, let's talk about the Fed itself, because oh boy, are they in a pickle. Daly's comments echo those of Fed Chair Jerome Powell, who last week basically said, yeah, we're probably cutting rates in September, because what else are we gonna do? But here's the thing, folks, cutting rates isn't a magic bullet. Sure, it might boost hiring and consumer spending in the short term, but it also risks fueling more inflation, especially with tariffs still in play. And let's not forget the bond market, which is already throwing a tantrum. Yields on short-term treasury bonds hit an intraday low after Daly's comments, signaling that investors are betting big on rate cuts. But what happens if the Fed cuts too much, too fast? You guessed it, asset bubbles, baby. Remember 2021, when low rates fueled a housing market frenzy that priced out an entire generation of first-time buyers? Yeah, good times. And here's the real kicker, the Fed's credibility is on the line. According to a 2025 Gallup poll, only 39% of Americans have confidence in the Federal Reserve, down from 58% a decade ago. Why? Because people are tired of watching the Fed play whack-a-mole with the economy while regular folks bear the brunt of their mistakes. Too slow to raise rates in 2021? Hello, runaway inflation. Too slow to cut rates now? Hello, labor market slowdown. It's almost like the Fed is driving a car with a broken GPS, and we're all just along for the ride. So, what have we learned today, folks? 1. Tariffs are the economic equivalent of a bad haircut, expensive, hard to fix, and everyone pretends it's not a big deal. 2. The labor market is having a midlife crisis, and the Fed is its well-meaning but clueless therapist. And 3. The Fed is stuck in a high-wire act with no safety net, trying to balance inflation, employment, and their own credibility, all while the bond market heckles from the sidelines. Welcome to 2025, where the economy is a circus, and we're all unwilling clowns. But hey, don't take my word for it. Keep watching Boss Economics World for more satirical takes on the economic madness, and remember, in a world of tariffs, rate cuts, and labor market meltdowns, the only thing you can count on is chaos. Until next time, stay skeptical, stay caffeinated, and stay tuned.